Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Let's take a look at some of the stories we're following for you in the BNN Bloomberg newsroom. Canada-U.S. Trade Minister Dominic LeBlanc says the trade agreement with the U.S. and Mexico should be renewed for 16 years. He made the point in a letter to his counterparts. LeBlanc is in Washington today to meet with U.S. Representative Jamieson Greer. Canada's official negotiations over its trade agreement with the U.S. have yet to begin. LeBlanc's letter comes ahead of the agreement's mandatory review. Prime Minister Mark Carney is not using the word recession to describe the Canadian economy. He says his government is laying the foundation for a stronger, more independent, resilient economy. Carney's public comments were his first since the country went into a technical recession, 2 consecutive quarters of GDP decline. He says the slowdown is due to clear decisions by the government on limiting immigration and reducing spending. Home sales in Vancouver fell in May by nearly 4% compared to last year. Apartment sales dropped the most, weighing down the overall sales total with a decrease in properties listed compared to last year. Greater Vancouver realtors say there's no obvious near-term catalyst to move the market. Quick look at the markets right now, and you can see the TSX hovering in and around record territory, not quite there, but still up by 0.86%, being led by energy and financials. South of the border, similar situation, close. S&P 500 up by 0.2, the NASDAQ up by 0.22 right now. Shares of Hewlett-Packard, Marvell, and Alphabet are moving today based on AI developments. Here to talk about that and more, our guest, Connor Brown, founder and CEO of City Different Investments. And Connor, thanks very much for joining us.
Good to be here.
Another day on the markets, another interesting day on the markets. Hewlett-Packard, boy, they put out some blockbuster numbers.
Yeah, they sure did. Really strong revenue growth. Their traditional server business really taking off. Interestingly, in a world where so many of the businesses out there are burning tons of cash flow, HPE looks like they're going to generate really strong cash flow this year and reduce debt. I think it's just this broader trend of everything anywhere near the AI build out is getting benefited from the increase in demand on this trade.
And it's been quite, the end of last year, we started to see a little bit of movement out. And then all of a sudden, everything's come right back into it.
Yeah, it really has. It'll be interesting. We spent a lot of time thinking about whether or not this is a bubble. And we think bubbles are really hard to call. And it's starting to feel like the beginnings of a bubble. We've got SpaceX coming next week. Anthropic filed for their IPO this past week. We're seeing big moves in everything related to the trade. There is real demand here. So this could go on for a long time, but starting to feel a little bubbly out there.
And is that a good or a bad thing that it can go on for a long time, or is it when it does go, it's really going to go?
Exactly. I think, we think people don't realize how much exposure they have to AI-related investments and broad indices these days. So something like 40% of the S&P today is in the largest 10 holdings. About half of the S&P is in AI-related trades. And so many businesses like Hewlett-Packard Enterprise that had strong traditional businesses are being transformed, and valuations are up to a new level based on this orders of magnitude growth in the build out of AI capacity. So, demand is real. We're AI optimists here at City Different Investments, but just remember, bubbles can unwind quickly. We think if you've got broad index exposure, you've got that exposure, but keep some of the portfolio diversified outside of it too.
I was going to say, what are you doing with this when you say diversify? How much?
well, talking my own book, we run strategies in small and mid cap US stocks and in global equities that aren't as tilted towards the indices. But you can find both in small cap, international, so Europe, outside of Canada, outside the US, businesses that are less related to this AI trade, and pair that with broad index exposure, which gives you a piece of the portfolio that can work in any environment. Because, you know, even if this is a bubble, if I'm calling it today on June 2nd, valuations could go up for 2 more years. We could see indices double or triple from here before a bubble pops. So we want you to have exposure on both sides.
So does this present some opportunities, though, outside of the AI surge that's going on right now? Are you finding there's some great opportunities elsewhere?
Yeah, absolutely. I think so much of quality as a factor has been out of favor now for a couple of years. Any traditional businesses, even the ones that we think are protected from AI competition, are really undervalued in the marketplace today. So we're excited about the opportunities away from the AI trade.
And which are there any that stand out for you?
I'll even say, like, we backed into some AI exposure through our Flex holding. We actually like that traditional business. We think they're outstanding capital allocators. We saw this. We've owned it for 5+ years. It's been a great business. But even there, stock has moved recently on building out a business that supports the build of data centers, which has been nice upside for us. But the right ones we think you can get to, not giving them credit for bubble-driven demand or AI-driven demand, but where there's potentially a hidden asset that can look interesting to us, like in the case of Flex.
All right, I just want to go back into it. And Alphabet, your thoughts on they just announced another $80 billion, selling $80 billion, including I think $10 billion to Berkshire Hathaway. Any concerns about the spending spree that's going on?
Sure. Yeah. One of the things that I've said all along is that this looks different than the internet bubble, because so much of the spend was being funded out of cash flow from these hyperscalers. And now even Google, even Alphabet, who's projecting around $500 billion in revenue this year, is turning to the capital markets to fund capacity build against AI data center capacity. Again, we are AI optimists here. I believe AIs plus our employees at Citi Different, AI plus employees across the economy in Canada and here in the US are going to increase productivity. I think we're going to see GDP growth out of it. But be careful about these order of magnitude multipliers in growth in capacity, because if we get ahead of demand, we're not right now, if we get ahead of demand, so much of that value chain is the capacity build. It's not just current usage. And so the backing out of that trade, if and when it happens, can be really painful. So the fact that Google is going, they're doing it super efficiently, less than 2% dilution on this capital raise. It's a big market cap, not that big a deal for Google. But it is wild how much money all of these businesses are throwing at AI capacity right now.
All right, Connor, we got to wrap it up there, but thanks very much for joining us. Appreciate it.
Thanks.
Connor Brown, founder and CEO of Citi Different Investments. Up next, shares of Marvell are soaring today. We'll find out why with our next guest. Stay with us. Marvell shares are soaring today after NVIDIA's CEO predicted the tech company will be the next business to hit a $1 trillion valuation. Earlier, we were joined by Felix Wang, Global Technology Sector Head at Hedgeye Risk Management, who talked about how realistic that prediction was.
It's about 237 billion market cap. So 3x, 4x what Jensen said. But look, I'm just curious what kind of gift basket Matt Murphy gave to Jensen for him to invite him on stage together, because this was a surprise. Marvell was going to have their own keynote. Matt Murphy was going to talk about interconnectivity, this is the key bottleneck in data centers, and how Marvell is a key pioneer of this technology. And Jensen just showed up, and and they had a lot of fun. I kept saying to investors, like, this $2 billion investment from NVIDIA cannot be understated. This is critical relationship in terms of trying to understand the next step in the frontier for AI data centers. This is a key relationship for Marvell. And as you can see by the stock today, it's soaring.
And I mean, numbers, it's a big number, but it's only about 1% of the valuation of the company. I mean, is that what makes it such a, I mean, is it just the name behind it that makes it such a key investment?
Well, you got to pay attention to every time Jensen opens his mouth and who his friends, partners, people he tout on the supply chain. So for him to step out and say, hey, Marvell is a key partner of us. They are the leader in interconnectivity. If you're looking into the future on how to reduce power consumption, improve density, you got to look at a company like Marvell. I thought it was interesting that he specifically mentioned AWS, right? And AWS and Marvell are very intertwined because Marvell is working on their ASIC chip, and that's one of the ASIC partners for AWS. So for him to directly say, hey, AWS, if you're really serious on being part of the NVIDIA ecosystem through what's known as NVLink Fusion, you got to consider Marvell. So I think that's also gaining some interest among investors today.
And from what you're seeing with Marvell, is it legit? I mean, is what he's saying, can they walk the walk?
I do think so. They are the key enabler of optical interconnect and SiPho tech stack. So what that means is that, we're right now, that's the key bottleneck in AI data centers. And CPO, which co-packaged optics, this is a buzzword that's been talked about a lot. And at Computex Taiwan right now, that's what everyone's really focused on. This buzzword means you extend that optical connectivity all the way into the chip package itself by positioning it right next to the compute or switch units. And this is the way forward for meeting the performance requirements as AI clusters get more and more dense, more and more massive, and the ability to move data efficiently get harder and harder, whether that's within or between data centers. So because of that logic, you got to look at who are the leaders in this area. And Marvell has to be on the top, or close to the top.
And who's the competition for Marvell then?
Broadcom. So Broadcom, Avago, Marvell is considered a much weaker sister to Avago, and for a variety of reasons. That's why it never gets as much attention as Broadcom and Avago. And look at Avago now. They've surpassed the $1 trillion market cap. But the thing is, it's interesting enough, even though Marvell may be inferior in some technologies, they still are able to generate more clients. They have Google on the CPU side, maybe on the NPU side. They have Maya with Microsoft. They have AWS on Trainium. So I think they're kind of left out of the picture here, but they are definitely relevant. And that's why I like it. It's our number 2 long, second highest conviction on our long list, just because I think it doesn't get as much respect as Avago. But Avago is also going to go up on these news from Jensen just because, again, people are focused on interconnectivity. That's a key bottleneck right now in AI data centers.
I guess there's no such thing as bad publicity, right?
Definitely. Any publicity from Jensen Huang, even if he coughs in your direction, it's positive.
and I mean, I'm looking at Broadcom's up as well today, so everybody's kind of taking a bit of a lift with this one.
Yeah, but right now, what we've been saying is all boats are lifted. But at some point, if the AI buzz or AI hype, if you say, kind of cools down, then we're going to have to look more into market share shifts. And NVIDIA, Broadcom, Marvell, they're all interconnected. Arista is another name, Cisco. So these are all part of the networking interconnectivity optics ecosystem. And we think Marvell is a huge market share gainer. But right now, just because of how steep this bottleneck is with interconnects and communication, all boats are lifted.
And any indicators when it might ease that?
So we keep a close eye on two things. One is token growth. Token growth from LLMs, as you may have heard from last night, Jensen keeps saying tokens are now profitable. Well, he's directly mentioning Anthropic because Anthropic was the first one to show a profitable quarter. But what about the rest of the LLM players, right? So we're keeping a close eye on token growth because token growth, a lot of people are saying it can grow exponentially from here as we transition from training to inference. But we have a good read. So when that growth rate steeply decelerates, maybe we're entering into another sort of part of the AI cycle, and maybe we need to take a breather. But we're not there yet, I would say.
That was Felix Wang, Global Technology Sector Head at Hedgeye Risk Management. Up next on the radar, what investors are watching right now, including some thoughts on ATS. Stay with us. Time for On the Radar, a daily look at the stocks, sectors, and stories moving the markets. Today we spoke with Patrick Horn, principal at Agilith Capital, to see what he's watching. We kick things off with his thoughts on ATS.
We had this for a while in the, 2015 to about 2022 or 23. And it kind of got expensive for us, so we let it go. And we think it's come back. They help automate different industry groups, healthcare being their biggest. There's a reshoring of healthcare, medical devices, insulin pumps, that kind of thing. When we talk about bringing back manufacturing, we don't necessarily bring back manufacturing the old way. A lot of it is robots and automation now, and they help put that whole assembly line together. They help do the measurement, the testing, the company has a new CEO. He's just started. They just had a conference call. We like what they had to say. Focused on free cash flow. Focused on increasing the amount of cash going through the system and coming out. It's going to free up some potential acquisitions. Their balance sheet is in order. They're trading at the cheaper end of their historical range. And if you look at their peer groups, they're about 50% undervalued. So we think the story has a lot to play out here. This was our first call with management. They just reported last week. The stock did sell off on it. We look at it and go, that's just a algorithm that kind of played out. But we think this is the exact environment. They have a nuclear side, they've got a consumer product side, and healthcare. And I think the one thing the market was disappointed by was the lack of growth in their backlog and their bookings. So you want to see that grow. But all of the other stuff, this new CEO is doing his job, and he'll get to that bookings. And I have no problem. I'm pretty sure they're going to have higher bookings in the future. This company's worth a lot more than what it is. So
where's the CEO coming from?
Oh, it's a good question. It's another. It's kind of another diversified industry or diversified business, and he's got similar background in the M&A. The former CEO has left for a bigger position somewhere else. I can't even remember. Hilder was the former CEO. I really like what he had to say. Like he was kind of a no-nonsense guy, squeezing everything out of the lemon, tightening the reins in terms of working capital. And that is right. Like that is what we look for in turnarounds. And this is a turnaround. This stock has really not performed for the market in like 4 years. So.
All right, let's get to the other one. TELUS.
TELUS, yeah. So you probably once upon a time, like year and a half ago, I was short all the telcos and on the idea that they're going to have to cut their dividends. We were made some money on it, and Bell cut their dividend, and we're still short Rogers because of their debt load. And we've been looking at TELUS as a potential change agent. It's going from kind of a negative story. Now, TELUS has not performed. It's actually been a dreadful stock to hold. It's 4 or 5 years now, and it just seems to go down every year.
Yeah.
There is new management, and it's the former CIBC CEO, Victor Dodich, who has done wonderful things at CIBC. Took CIBC from really what was a bank, a Canadian bank, smallest that was most likely to run into sharp objects, to actually a premium bank with a premium multiple. That's the first time CIBC has actually broke out of that ranking. So they actually have a growth multiple in the banking sector. We think that that kind of magic will happen with TELUS under his leadership.
But even in telco, I mean, aren't they? Where do they go?
Where do they go? So they don't have to go very far. So they have like an 11% dividend.
Yeah.
We know that's going to get cut. Question is, how much does it get cut? And they've got so many different levers, so many different assets that's not being properly valued by the market right now. So they've got this healthcare side, they've got this farm agricultural side, they've got information technology side. They could sell that off and collapse their debt. And our best guess is that you might see a 30, maybe max 40% dividend cut. That gives you a 7% dividend. That's a champ. That's still a very undervalued dividend. And and then you slim down, like they've got the data center side. They got 3 data centers that they're working with the government of Canada on in BC. And you talk about a sweet spot. And the US is complaining about how these data centers are competing with the average person in terms of electricity prices. I mean, BC, 90% of their electricity is hydro, right?
Yeah.
So talk about a perfect spot to export this compute power all over the world and in Canada and have it our own. And TELUS is going to be in charge of that. So we that's part of the growth engine. We also think that what we're seeing in wireless prices, we're hitting rock bottom now. We keep on bouncing down to the same levels, but we're not going down any further. So we think we've cycled through the worst part of the compete cycle in wireless margins. Right. So there's a really good story here going forward on TELUS.
That was Patrick Horn, principal at Agilith Capital. Up next, SpaceX is going public at a valuation near $1.8 trillion, but is it worth it? And should you invest? We'll find out after this. Canada-U.S. Trade Minister Dominic LeBlanc says the trade agreement with the U.S. and Mexico should be renewed for 16 years. He made the point in a letter to his counterparts. And LeBlanc is in Washington today to meet with U.S. Representative Jameson Greer. Canada's official negotiations over its trade agreements with the U.S. have yet to begin. LeBlanc's letter comes ahead of the agreement's mandatory review. Prime Minister Mark Carney not using the word recession to describe the Canadian economy. He says his government is laying the foundations for a stronger, more independent, resilient economy. Carney's public comments were his first since the country went into a technical recession. 2 consecutive quarters of GDP decline. He says the slowdown is due to clear decisions by the government on limiting immigration and reducing spending. Shares in Marvell Technology are surging today. This comes after NVIDIA's Jensen Huang predicted the semiconductor and networking company will be the next business to hit a $1 trillion valuation. That's more than 5 times its current capitalization. NVIDIA took a $2 billion stake in Marvell 3 months ago. Quick look at the markets, and the TSX Still up, slipped a little bit, but and down below 35,000, still up by 0.75 of a point for the day. South of the border, you can see the NASDAQ right around a wash right now. Ooh, it's heading back down. We'll see if it goes into the red for the end of the day, but still solidly above 27,000. The S&P 500 also a wash right now, still over 7,600. SpaceX is heading to the public markets, and the hype is enormous. But behind the headlines, the valuation is the real debate. What is this company actually worth? Where does the money come from? And should you buy? To answer these questions, we have Nicholas Owens, equity analyst at Morningstar. And Nicholas, thanks very much for joining us.
Thanks for having me, Roger.
All right, the talk is 1.8 trillion, but you think that's a lot more than what it really is worth.
Yes, I have to say that's because we've taken what we're calling what is a probability-weighted approach to valuation. So in our most optimistic scenario, in which, let's say, everything goes right, we get to a 1.9 trillion valuation. So that you could square that with the IPO price easily. But the point is that investors would have to essentially believe that the Starship rocket will be fully reusable and that data centers in space is viable and commercializable. Both are very, very possible, but you have to believe that those are going to be true to get to that, let's say, 1.9 trillion in my view.
And how realistic do you feel they are, those things? You say they were possible, but it sounds like there's got to be a lot of buts in there.
Well, that's the tricky thing with probabilities, let's say. I actually think the Starship reusability is more than likely. It's an engineering problem, a tricky one because of the heat shields. But one way to look at it is if anyone can do it, this company can. And the data centers in space, we've modeled a handful of scenarios that with the electricity and cooling and the other engineering stuff that relates to putting GPUs in space, essentially, it's more than likely doable. So you just have to. It's just that it's not certain. So putting, we'd say we put more than even chance on the Starship being reusable, and the, let's say, fully loaded moonshot scenario where the Starship, these data centers in space are fully 100 kilowatts each, et cetera, that puts our valuation at 1.9 trillion. We give that actually a 7% likelihood today. And we'll know more over the coming months and years and could adjust those probabilities.
What's a more realistic number to you?
Well, so you boil it all down, those probabilities, and that's where we get to the 780 billion valuation. 611 of that, by the way, is the rockets and Starlink. Those are actually very strong businesses.
And with the Starlink, we've got some numbers here. There's about 2 billion people that might fit the potential customers for it.
Yeah, we took a view of, and the other thing to think about, in terms of the information that the company's putting out, they put very broad estimates of, let's say, what they call and what one would call the addressable market. We took a more let's say, conservative approach to say what's plausible in terms of Starlink serving customers that, let's say, Starlink is best positioned to serve people in lower density areas and special applications like Wi-Fi on airplanes, and that gets you to essentially a quarter of the world population lives in low density areas. So that's still 2 billion people, and if you assume that through various agreements with telecoms and others, they might be able to address a good portion of that market and have some recurring revenue from those folks, that gets you to the valuation that we have published.
And I mean, is there the possibility Starlink could go beyond into more populated areas if price comes down, or there's a reason for it?
It's possible, and we give them, let's say, benefit of the doubt that they'll address some percentage, a small percentage of people in, let's say, higher density areas. What you run into there is just, for example, serving broadband internet to, say, a downtown, high population city, it presents problems in terms of the bandwidth, the latency, and a fiber optic network is just way better at doing that. So that's why we look at let's say the other end of the scale is way more in SpaceX's advantage in terms of population density.
All right, and the other side that you say is pretty solid is the launches, but they have a pretty ambitious plan by 2030. Did I read 1 every hour? Is that what they want to do by that point almost?
Yes, and that really is hinged upon the new Starship, which they ran their 12th test flight the other day. That plan really hinges on that proving to be highly reusable. That is to say, turning it around in hours, not weeks or months, the way, let's say, the space shuttle was, or a rocket that needs heat shields replaced would be. So that is the plan, and that is uncertain, though possible.
And then with the hope for the AI business, where do you see that?
Well, and that one is really sort of the swing factor, if you will. Again, very exciting stuff going on, and a lot of different projects underway under the now Starlink XAI business. The biggest one that we took a look at closely is this idea of putting GPU or AI computing capacity into a cloud in orbit, where there's some potential advantages in terms of solar electricity being almost free, and you have to figure out a way to cool the chips in the vacuum of space, which we also think is doable. And that then becomes and then there's the satellites are sort of networked to each other in space using lasers, we believe, and then you have to move the data up and down from Earth for your AI computing. There again, we sort of see there's some decent chunk, in the let's say very optimistic scenario. We think this could be doable, provable, and commercializable, and they might even essentially install up to let's say a fifth of the global AI cloud computing in that 2035 or 2040 scenario.
All right. Well, we have to, Nicholas, sorry, we have to wrap it up there. I appreciate it, though. It's going to be interesting for sure. Thank you very much for joining us.
Thank you.
Nicholas Owens, equity analyst at Morningstar. When we come back, Michaels is betting more shoppers will head back into stores, but can that strategy actually drive growth? Our conversation with the CEO is next. At a time when most retailers are doubling down on e-commerce, Michaels is taking a different approach. The traditional craft retailer is expanding into party and celebration categories, as well as testing new in-store experiences, all in an effort to bring more customers back into stores. For more, we sat down with Michaels' CEO, David Boone.
Our business, we've essentially refashioned or repurposed the business to be the center of creativity and celebration in every community in North America, and those words are very specific for us. And if you think about our business, we've always been in the creativity business. You started saying arts and crafts. What people don't know is we're also part of the celebration business. We sell a lot of seasonal decor. We help people celebrate the holidays. So it was very natural for us to go into party supplies, helium balloons, and all the related products that help people celebrate life's moments.
And how has that been going? How has the transition?
Been fantastic. So, we've attracted millions of new customers across our chain as a result of the expansion into party and the expansion into fabrics and other crafts as a result of the exit of Joanne from the market, particularly in the US, but we're seeing it in Canada as well. And so it's been a really good time for us to have expanded into those markets and serve those customers.
And what were some of the challenges? I mean, one that comes to mind, helium.
Yes.
Can you get helium? But what are some of the real challenges of bringing those two together?
Well, so the big challenge is we needed to go fast. And so as an organization, we moved very quickly to build a party shop by Michaels in every store in North America and a knit and sew shop. And then build up the network and productivity and the supply, in particular in helium. And that was a lot of effort for our organization to set that up. And yes, we have helium, and yes, we can provide balloons, and we've got a great network of suppliers across North America.
And from the expense side with doing all that and implementing it, how did it come together?
So it's great. We're a business that's owned by Apollo, and they were happy to invest in these opportunities and really drive this business. And certainly consumers responded. So it was a good investment. We added nearly 1 million hours of labor to our stores in 2025. So it's been really a great story for Michaels.
All right, and the other side of this, the DIY, do-yourself, bringing together people into the stores to kind of stay in the stores, isn't it?
Well, there's this amazing trend happening right now, I'd say globally, but certainly in North America, where a trend towards authenticity, hands-on creativity, in-person celebration. Things like, if you look at our website, things like analog crafts, searches are up 130%. Girls' night crafting, it's up 250%. And so what we are doing is leaning into that, not only from an assortment and point of view, but also creating events in our stores. And so every weekend, there's events in our stores. If you were in our stores during the Christmas or the holiday season, you could have come in and painted ornaments and take them down. We're adding services that allow people to personalize things and send them to their loved ones. As an example, a personalized Christmas ornament. So lots of things happening to drive engagement with our customers and lean into that trend.
What is driving that, do you think? Because we were talking about it off air. I saw about film. Young people especially are going out to the theater again.
Yes.
Is it people who have just been 5 years of the pandemic, 6 years ago since the pandemic, and it dragged on? Is it people just want to get out again?
I think there's a bit of that. I also think there's a bit of inundation of screen time. And, our studies and our stats would say, particularly young people, something like 50% of them are looking to reduce screen time. Like that's what they're saying they're doing. And looking for outlets, whether it's going to the theater, and in our case, doing hands-on creative crafts. They're looking to get together with friends. They're looking to engage with others in a different way. And there isn't a place that I don't go today, and I say I work for Michaels, I generally don't say what I do, and they tell me about something they have done creatively with friends, whether it's painting a mug or doing an event together. So
it creates the memories. And how are you keeping people coming back? What are you doing to, they've done it once, do they want to do it again? Or how are you?
So certainly one thing we do is we have a pretty strong loyalty and reward program that we've just rolled out across Canada. We have it across North America. So that's just a very mechanical way to connect to our customers. But secondarily is mostly staying on trend. So, we develop 24,000 different products a year and roll them out across our network. And so ensuring that we have the next greatest thing combined with in-store events and services really is the model that's working for Michaels.
And you mentioned people wanting to get away from the screens. Are you still working from the online side too, though? How are you combining that without getting too far? Well, look, so it's very interesting. Our e-commerce business is growing, quite dramatically. So people are still shopping online, but our store business is growing as well. One of the paradoxes of this kind of analog hobby movement is, although people are craving this in time, a lot of what they're finding and they're discovering online, like in social media. They're following an influencer who has something they create, whether it's a keyboard or how they decorate their house for a party or what they do for their kids' parties or some new version of knitting. There's a lot of discovery online in social media that then drives customers into physical channels. And do you see expanding? You mentioned at home. Do you see Michaels expanding into maybe at-home parties and things like that?
I think it's in the realm of possibilities. Right now, we're going to focus on updating the store experience, and we're very focused on that.
And partnerships with this, it seems like there's opportunities for that. Are you exploring something like that?
Well, we do partnerships and collaboration. So some interesting ones is we just launched a set of products with a designer. A great collaboration, and his name is Jonathan Adler, and that's allowed us to create new and unique products, both do-it-yourself creative kits, in addition to home decor items. So we do partnerships in that space. You see us do a lot of interesting things in birthday parties. So one of the interesting things is for families, our birthday party business in-store is growing 5x, and that is people wanting to show up, do hands-on crafts with their kids and with their families. And we have tons of partners through Disney, licenses that people are fully engaged. So there's lots of opportunity for Michaels to partner.
All right, and with this, what's been the biggest lesson as a CEO of doing this on such a scale? I mean, this is a large scale. It's not one little store you're doing it in. What's been the biggest lesson for you?
The biggest lesson for us as a team has been to be very focused on the customer and very focused around prioritization so we can move fast and serve customers who need to be served.
It was David Boone, CEO of Michaels. Still ahead, today's market movers with Bloomberg's Matthew Griffin. Joining us now for some movers south of the border is Bloomberg equities reporter Matthew Griffin. Matthew, how are you? I feel like we haven't chatted in a while.
Roger, well, yes, I'm back from vacation and rested. How are you doing?
I'm getting sick and I'm not rested, so one of us is doing great. Good to see you. I hope you had a great vacation. Let's talk Victoria's Secret and solid report from top to bottom.
Yes, so Victoria's Secret shares surging more than 40% after the lingerie retailer reported earnings that topped expectations. They also raised a full-year outlook for their net sales, so they now see net sales as much as $7.13 billion U.S. They previously saw just under $7 billion. Now, some of the really staggering scale of the share reaction here might be because the stock is heavily shorted. Data from S3 Partners shows that about a fifth of the shares that are available to trade are held short by investors. And so when you have this kind of good news, you can have sort of a squeeze where people are forced to close out those short positions. That drives the stock even higher. That being said, this isn't all technical. Investors have been looking for signs of a turnaround under CEO Hillary Super. And so far, these signs are good. This report is more evidence of that. For example, their Pink brand, which is aimed at younger shoppers, has been doing well, has been gaining ground. So there's some fundamental reason for optimism as well contributing to this rally.
All right, and there's some people losing their shirts for Victoria's Secret right now by the sounds of it. Okay, let's talk.
Yes, might be.
Let's talk HVAC, farm equipment. What's going on there?
Yes, you have several corners of the industrial sector today, Roger, that are rallying, all for the same reason. The Trump administration is temporarily dialing back some of the tariffs it's put in place on metals and products made for them, so that's steel and aluminum. They, for example, are cutting tariffs on imported farm equipment to 15% from 25%, also on residential HVAC systems and parts. So, you know, your home air conditioners, that kind of thing, and on certain imported construction equipment. This has been something the administration has really struggled to get right, is what are the correct tariff rates here. They want to sort of erect this tariff wall. They want in U.S. metal production, but they also want industrial manufacturing to happen here. That's hard when, you know, a lot of the products and parts are facing high levies. So now dialing back some of these rates, that's sending stocks such as Deere, Caterpillar, Lennox, and Carrier over in air conditioning higher on the day.
And any surprise ones benefiting from this? So maybe caught you, if you were kind of digging around, did you find any that caught you off guard but benefiting because of that?
One that maybe a niche name, Regal Rexnord. This is an industrial company. They do, you know, motors, powertrains, that kind of thing. And actually today I learned they do motors for air conditioners. They're being called out as one of the beneficiaries of this tariff change. Not, you know, furious rallies, not on the scale of Victoria's Secret for these names, but industrials have had a really good year already. I mean, you look at names like Caterpillar up more than 50%. And so anything that can push these large and small names higher is a pretty big win for investors at this point.
Yeah, I'm looking at, it was Regal Rexnord, right? Is that what you said?
Yes.
Yeah, it's up.
RRX is the ticker there.
It's up about 3% right now. I think people will take that for the day.
Yes, I think they will, especially with, again, you know, all of the gains recently. Any more upside is kind of icing on the cake for investors so far in 2026. Got
to wrap it up there, Matthew. Good to see you back, sir. Thanks for joining us as always.
You as well. Thanks for having me. Hope you feel better.
All right. Thanks. Bloomberg's Matthew Griffin. Well, join us Wednesday at 3 p.m. Eastern for Know Your Options with Chris Tom of Moat Financial. Send in your options trading questions now to knowyouroptions at bnnbloomberg.ca. And that wraps up this edition of Trading Day. Have yourself a great afternoon.